November stocks to keep an eye on. Welcome back to our YouTube channel Shareholdr. In today's video, we are going to find out stock to buy this talk November. The S&P 500, Nasdaq, and Dow Jones hit records during the last week of October. The resilient and ever forward-looking market shrugged off slow quarter GDP growth and other concerns in favor of the positives. The picture of improving earnings includes everyone from Microsoft MSFT to Ford F. The margin outlook for the S&P 500 also remains strong for 2022 and beyond, despite rising prices and bottlenecks in the supply chain. In addition, the consumer-led U.S. economy showed signs of recovery in the first month of the fourth quarter, from hotel occupancy to restaurant meals, and consumer confidence rose in October after 3 months of declines. The bullish outlook is further supported by low interest rates, which will continue to favor equities for the foreseeable future. That said, some big names in the market in general may face a short-term retreat after the October rally, with the Nasdaq 100 QQQ ETF currently at the peak of technical overbought levels. Therefore, investors may want to turn their attention to strong stocks that are still trading well below their November highs. The Walt Disney Company DIS. COVID temporarily squeezed Disney parks and theatrical businesses. The entertainment titans Parks and Resorts from Disney World to Orlando at the Shanghai Disney Resort are now open. Additionally, it has begun to release films in theaters, which receive strong screenings under the circumstances. Most recent releases, like Shang-Chi and the Legend of the Ten Rings, have performed well at the box office, and more people are ready to return to theaters in 2022. Disney Star Wars and Marvel movies dominated theaters before the pandemic and will likely move forward. However, his new crown jewel is the burgeoning TV streaming business, which he strengthened with his deal from Fox and ownership of Hulu. Disney streaming offerings like Disney+, Hulu, and ESPN+. These are also available in a package which is very competitively priced next to Netflix. Disney Plus has already amassed 115 million subscribers to surpass their guide. The entertainment conglomerate initially set a target of 60 million to 90 million by 2024, and now hopes to reach 230 million to 260 million by then. And it already has about 175 million subscriptions on Disney+, ESPN+, and Hulu. Netflix ended the third quarter with 214 million. Despite difficult conditions, Disney's revenue fell only 6% last year. The company estimates that fiscal year 21 revenue will increase by 3.5%, with 2022 expected to increase by 25% to destroy its pre-COVID totals of $16 billion at $84.78 billion. Meanwhile, their adjusted earnings are expected to increase by 22% and 106% respectively. Disney earns a Zacks rank right now and has squashed our EPS estimates by an average of 114% over the past 4 quarters. Disney shares have skyrocketed thanks to strong streaming numbers and the reopening of its parks, up to 45% from last August. This run includes a 6% drop in 2021 as Wall Street took profits and allowed its valuation to cool down a bit. Disney is now trading 15% below its records and 50% off year highs with 32.6x future earnings. Roku Inc. Roku TV streaming sticks have gained impressive market share in the gamer space with Amazon and others. Its technology is also built into some smart TVs and was the #1 smart TV operating system in the US in 2022, having captured nearly 40% of the market. Roku's hardware business continues to generate solid revenue, but its booming digital advertising segment made it stand out in Wall Street. Revenue from Roku's ad-centric platform accounted for more than 80% of total sales in the second quarter and 71% in 2022, growing at a much faster pace. Roku allows marketers and businesses to buy targeted ads, promote their movies, shows, platforms, and whatever else they sell. The company also boosted its bona fide advertising through acquisitions, including Nelson's video advertising advanced service business, and announced a partnership with Shopify in late September. The business is poised to thrive as most of the ad dollars move to digital and businesses pay to find people to avoid ads when they can. Additionally, Roku has increased its spend to release more content, including original programming on its ad-based Roku channel that allows users to watch free, ad-supported movies and TV shows. Additionally, the company is expanding its international reach outside the US and Canada. Zacks estimates Roku's FY21 revenue will increase 60% from $1.78 billion to $2.85 billion. Sales will then increase another 38% or $1.1 billion more in 2022 to extend its streak by around 40% and revenue growth of 60% over 5 years. Furthermore, it is expected to move from an adjusted loss of 14 cents per share to $1.35 and then up from another 34% to $1.81 per share in FY 2022. His positive earnings review activity helps him earn a Zacks rank number 2 and has consistently squeezed our quarterly EPS estimates. Roku stock has risen 500% over the past 3 years, including a streak of 50% winning streak in the past 12 months. The streaming TV company has a wild ride of ups and downs in 2021 and is now down 35% from its late July records. Some of the sales were due to a reduction of margins for its devices and a sequential slowdown in sequencing hours. But these are more short-term concerns, and streaming TV is the future of entertainment. The TJX companies. TJX is a clothing and home decor retail operating approximately 4,665 stores in 9 countries, including the United States, Canada, the UK, and Germany. The company also operates under TJ Maxx, Marshalls, and Home Goods, as well as the more smaller Sierra and HomeSense brands. The company has been successful in both in-store retailing and expanding its e-commerce and digital offerings. TJX has carved out a strong niche within a fast-changing traditional retail landscape that has seen Kohl's, KSS, and Macy's M struggle as shoppers gravitate towards Target, Amazon, and other e-commerce sites like Etsy. The pandemic crushed TJX, with revenue down 23% in 2020. Thankfully, its stores reopened, although some closed for parts of the second quarter, mainly in Canada, Europe, and Australia. Despite some lingering hitches, buyers have returned to their favorite locations and spent a lot of money online, and let's not forget that American consumers are willing to spend a lot this holiday season. Revenue for the current year jumped 50% to $48.18 billion, surpassing the pre-pandemic total of $41 billion. Hence, its sales are expected to increase another 7% next year. Additionally, its adjusted earnings are expected to rise from 31 cents per share in the prior quarter year to $2.99 per share, and increase by more than 15% next year. TJX's long-term earnings review went in the right direction to help you get a Zacks number 2 purchase. The company has also beaten our EPS estimates in 3 of the past 4 quarters. Additionally, 13 of Zacks' 15 brokerage tips are strong buyers. TJX gets an A rating for growth in our style scoring system, and its 1.6% dividend yield outperforms Walmart and the 10-year U.S. Treasury. TJX shares have risen 80% in the past 5 years and outperformed the market over the past decade. The company had a hot run over the past year until it started falling off its records in late August. TJX is currently trading more than 10% below its highs and is below the neutral levels of the RSI. It is also trading at a 6-month low in forward earnings at 19.6x, which also marks a discount from the industry average of 24.6x. And a recent comeback sees it revert to its 200-day moving average with the release of the quarterly results in mid-November. Tell us in the comments section your view on this topic. That's it for today's video. Consider subscribing to our channel by clicking the subscribe button down below. Thanks for watching.